Good morning, everyone. Jen Tozer, your portfolio manager here, to talk about a not very fun topic, which is Russia and how they've advanced on the Ukraine. I am not a political expert, so I'm not going to be able to speak knowledgeably on whether they will continue their advance or they won't. But what I can talk about is how I think that this will affect the markets. I believe there are going to be short-term, medium-term, and long-term effects. And when I talk about short-term, I'm not talking about the attention span of a teenager. I'm talking about probably the next 12 to 18 months. The short-term effects we're going to be seen in North America, and those are going to manifest in stock market volatility. We're seeing that today, and we're going to continue to see that. However, it's unlikely that our day-to-day operations are going to be greatly affected. The second place that's going to see the medium-term effects is Europe, and those are going to be a lot more severe. Fortunately, we do not have a large part of our portfolio or a large part of our portfolio committed to Europe, so we've got a bit of insulation there. And then the long-term effects are going to be Russia. They had trade sanctions for what they did in Crimea. They're going to have trade sanctions for what they do in the Ukraine. And then I'm trying to think about what is sort of what they call tail risks. What else could potentially happen? So I was thinking back to '98 when we had the Russian bond market collapse, and I was wondering if that's actually an issue currently at this time, because it did create some serious short-term volatility. Well, Russian debt only has about 64 billion held by non-Russians. Now that seems like a big number. I don't have 64 billion, hanging around. But to give you a comparison, Canada, which has about 1/4 of the people, but roughly the same size GDP, has 334 billion held by non-Canadians. So as a percentage, it's not that big. And from a strategic point of view, Russia right now is getting all of their money, or most of their money, from the export of oil and gas. And I sent a little chart out with this email, which shows where it's coming, where it's going to. But basically half of it's going to Europe and half of it's going to China. So it's going to be very difficult in the short term for Europe to replace that energy supply because it's mostly natural gas, and natural gas is for a large part landlocked, so we can't easily ship over natural gas or ramp up our supply at the speed that we're going to need to. But over time, I think Europe will be looking for better sources of energy. And that brings me back to the oil price, which we've seen a lot of short-term spikes in the oil price. But remember, the current spot price is very different from the futures price. The futures price is really where oil is bought and sold by the corporations, and it's still sitting around $80. At the spot price at $100, that's basically just financial markets or people sitting at a desk buying and selling. A good thing in the short term about high oil prices is that it has a similar effect to raising interest rates, so we may get some relief on the pace that we raise interest rates. And in the long term, there is no cure for high oil prices like high oil prices. So that's my 2 cents for today. Call me if you have any questions.